All right. So I'm guessing it won't be a surprise to any of you to hear that the market for early stage financing is a bit tight. That, of course, is why so many of us are here. But we also know that the best companies are, in fact, getting funded. In fact, these days, at terms that can be pretty good. We're seeing deal terms that look maybe a little bit more like 2021 terms than 23, 24 terms. So, for certain companies, there are certainly good opportunities. We know that's not by luck, but that's because people are focused. For those companies that know where they're going, that know what the market looks like, and know how to tell their stories, those companies are connecting with the investors who are writing checks. So our focus today is to help all of you become one of those companies. So my name is Paul Ellis. Really pleased to have you all here today. We've got a great turnout for this Tech Week event on maneuvering the current venture capital climate. Today it's going to be about moving beyond the noise to figure out what really matters. We're going to be talking about what investors are actually investing in, how to position your company so it stands out, how to get your term sheet over the finish line, and what is the next phase? What is that next new area where we're going to see breakout companies? So I'm really pleased to have a great panel today for this discussion. We have a couple of seasoned investors who spend a lot of time thinking about and making investments in early stage companies. We have Raju Rishi of RRE, and we have John Bresler of EJF. So thank you both for joining us. I know I'm really interested to hear what they have to say. I know we all are. So with that, we are going to jump right in. Before we get into substance, we're going to do quick introductions on the panel. Again, my name is Paul Ellis. I am managing partner of Ellis Law Group. ELG is a 12-person boutique firm with our offices here in New York and lawyers as well in Chicago, San Francisco, and LA. We work primarily with startup companies and venture capital funds, basically technology companies and funds. Our clients are looking for us to give them cost-effective solutions to their legal needs so they can focus on growing their companies. Beyond venture capital, we work in areas of general operations, formation, structuring, IP protection, employment agreements, equity plans, and M&A exits. Our lawyers all come out of top schools and major firms, so we can give big firm expertise with the more personalized attention and the cost structure of a boutique. And in recent years, we found a lot of startup companies coming to us after being with a big firm because they found that our expertise with startup and venture capital, plus our reasonable billing rates, made for a very compelling value proposition. With that, I will turn it over to Raju.
Your choice. All right, yeah. Hi, Raju Rishi. I'm with RRE Ventures. Can't believe this, but we've been in New York for 32 years, which is crazy. OG firm before New York was New York. And we've seen it grow. We're working out of our 8th venture fund. All of our funds are between 250 and 300 million in size. We write checks into small number of checks into seed, where we typically do not lead. We'll put in minority ownership and get access effectively to the Series A. Our sweet spot is Series A financings. We're not peculiar on verticals. We're pretty agnostic. Anything that has got a good technology bent to it, and we see a good fit with our thesis. And then, we'll reserve a bunch of money for pro rata rounds down the road. There's 5 partners. I'm one of them. We have an action office down in South Florida as well. So we split our time between those 2 venues, mostly for the weather. So anyway, that's us, and we're a staple. We're up in 59th Street if you guys are around there.
I'm Jonathan Bresler. I'm the managing partner of the EJF Ventures Fund. That is an early stage fintech platform that's part of a broader asset management platform called EJF Capital. EJF Capital is a $5.5 billion asset manager based in the Washington, D.C. area. We're 20 years old, focusing exclusively on financial services across the capital stack. The venture platform is deploying capital out of our second fund. We've got about $200 million of capital under strategy. We invest roughly $500,000 to $7.5 million in seed to Series B opportunities. Our predominant areas of focus are bank technologies, wealth management and capital market solutions, as well as blockchain infrastructure. Thanks for having me, Paul.
Great. Thank you both. All right. So to jump in, guys, it would be great to hear sort of your high-level assessment of what the venture capital market looks like right now for early-stage companies, what you're seeing and what your expectation is over the months and, say, the year to come.
Sure. I'll start. Well, to surprise very few people in the room, there is a tremendous amount of dispersion, and that is creating, I think, unique opportunities, but it's also, I think, sending some pretty concerning signals in a few different areas. I can say personally that we've seen a number of opportunities over the last, call it 8 to 12 weeks, where companies are seeking can-do valuations with will-do products, meaning they've got a lot of, I think, false optimism on where their product is with respect to its capabilities today, and they're seeking valuations that, in my opinion, should substantiate a product that's substantially more developed or mature. Yet they're finding funding by, I think, some pretty reputable investors out there that are willing to pay prices that are really head scratching. And then on the flip side, we're seeing some really unique value, particularly in areas where they lack some of the flash of the shiny objects of the day, AI, blockchain infrastructure, and things like that, more traditional SaaS-style enterprise solutions, which admittedly are more ripe for disruption today, given some of the macro developments, but they're being priced, I think, very, very reasonably with high-quality co-investors, really strong slates of initial customers, and those valuations are not materially different than what we saw at the trough of 2023 and 2024. So candidly, it's all over the map, and there's a lot of story. There's a lot of head scratching, but still a lot of opportunity.
Yeah, I kind of see the same thing. I mean, I think it's like a city divided. There's a bunch of startups out there that are just struggling to find investment, and there's a lot of frothiness in the AI sector, of course, and a lot of VCs are sort of competing for the same deals. And so you do see these incredible markups on companies that are sort of relatively nascent. And then you see a bunch that are, reasonably good companies that have good product and, good product market fit that, folks are avoiding. And I think it's the result of, just the state of technology inflection points. There's been 4 technology inflection points in our lifetime, right? And they've made all of the money for venture capital, all of it. So the first one was PC, the second one was internet, the third was mobile, and the fourth was AI. And the reality is the PC and the mobile stack are very similar because they're all hardware-based, ecosystems. So the platform companies that got created in those spaces like Microsoft and Unix, Linux stuff, and Apple OS, Intel made great money, and then applications sat on top of that layer and made a boatload of money. Same thing true was for mobile. So you had Palm Pilot, BlackBerry, iOS, Android, and then all of the applications like Uber, and obviously billions of dollars were created. the AI and internet are very, very similar because they're all query-based architecture. I ask a question and I get an answer back. And sorry, I'm losing the mic here. Try this one. Sorry. And so what winds up happening is the same thing that happened in sort of the dot-com era. A lot of money was poured into the platform companies. And so you see $287 billion worth of financing going into OpenAI, Anthropic, Liquid, Llama, Gemini, all of that. And, you know, application companies that are leveraging some of those platforms are also getting some finance. But I think there's going to be a massive problem down the road. And we saw this in the dot-com era. And I think people are getting a little bit wise to it. So what wound up happening is people poured so much money into the platform companies for the internet, which were called Alta Vista, it was Lycos, it was Yahoo, it was Mosaic, Firefox, Ask Jeeves. They don't exist. There was a newspaper article that came out that the browser wars are over. Alta Vista has won. And that was a year before Google was born. And we saw death and decay, right? Money being poured into these platforms, and then all of a sudden, you know, better algorithm. And what do we see? 287 billion going into OpenAI and all these platforms, and DeepSeek comes out, trains for $6 million, right? And everybody's sort of like, whoa, that's a precursor to kind of what's happening. So I think, you know, there is a lot of money being poured into AI, but I think people are getting even more selective about some of those. And the reality is, you know, there are some companies that are going to get frothy valuations and some that aren't going to get priced out at all. But you have to have an AI story. So, did you want to comment on?
Yeah, I would just add a couple small tidbits to that. And I would say the road for this trade is substantially shorter, just given the rapid pace of development of technology. And, you know, while we might be in the nascency of some of the technology, I can tell you from an investment perspective, it feels a lot later cycle already. So for, you know, my fund, we scoped a number of private market solutions for AI, for our workflow, for our data. And we went on an expedition essentially for, call it 10 weeks. In the first quarter of this year, we evaluated half a dozen to a dozen solutions, many of which were in the market raising capital. And the convergence of those platforms in just the 12 weeks was unbelievable. And some of those companies had raised tens and tens of millions of dollars at extremely rich valuations. Some of them had raised very little capital at, you know, essentially reasonable valuations, and the differences were minute. So we can see a mile down the road, there's going to have to be massive consolidation. There's going to be, I think, a major reckoning for a lot of these companies that are being priced to perfection when a competitive solution can be built for a pittance today. And essentially, it's a land grab. So it's whoever's the best marketer, whoever gets the few whales to coalesce around their solution is going to win. The product, candidly, is going to be very commoditized very fast.
Thanks for that. There's so many directions I can go, but I guess I'm going to focus on one, which is what I'm hearing is it is kind of like the tale of two markets. I mean, there are some companies that are doing really well and are raising money hand over fist at eye-popping valuations, and other companies that are not raising at all at any valuation. So what is it that's separating? Is it AI versus non-AI? Is it market segment? Is it team? I mean, is it connections, relationships? What is it that's making the difference?
Well, I mean, I think it all boils down to team at the start. And, you know, there are a lot of teams out there that don't get sucked into the trap of I need to raise the most money at the most optically appealing valuation because they recognize the challenges that come with that. And you can build substantially more efficiently today than you ever have. So when we see rounds of 10, 20, 30, $40 million, the first question we ask, irrespective of the valuation assumptions, is what are you going to do with this amount of money? And Why do you feel like you need $30 million when you're a team of 14 people? Even if you are growing really, really quickly, that's a lot of money. And that money can be spent substantially differently today than it could even 2 or 3 years ago. So I think if you have the right story and you can triangulate your capital needs with a legitimate use case, there's a lot of money out there that's willing to support those stories. If you're raising because you feel like it's what you should do as a founder to try to maximize the optics, to generate buzz, to then build your product, that's a bad playbook, in my opinion. And we tend to shy away from those opportunities, and we try to, filter them fairly quickly. Beyond that, boiling down the team and then product, I think a lot of it has to do with the addressable market and the nature of your sales cycle. Certain solutions, we, at least based on what we focus on, which is enterprise SaaS for financial services companies, we know what resonates with our end customers. We have a lot of them as investors in our fund. We have a deep network of ecosystem partners that we've worked with across our platform for decades. And there are a lot of solutions that are being developed that are really interesting products, but the sales cycles for those solutions are going to be years. And you need to be cognizant of that as an investor. And that has to factor into the structure of the investment, the ask, the valuation assumptions, and all of those things. So if you don't have a coherent answer on sales cycle, partners, use of capital, I think that can make or break whether you have a successful round.
Yeah. I mean, I think, all investors look at 5 things, and you guys know what they are. I mean, they look at the team. Do you have subject matter expertise? Do you have, a business as well as technical, sort of team associated with it? What's the market size? Is it billions of dollars or is it millions of dollars? And millions of dollars are not interesting. And you got to sort of divide your market appropriately, because VCs will look at it and say, you think it's $1 billion, but we look at your share of market as being, 10 million. The third is product market fit. The fourth is, competition. And the fifth is your business model and business plan. But I'm going to tell you that's, if you want to build a solution for the future, you got to change. This is going to be a wacky, wacky market. I'm telling you now, there's going to be an incredible amount of carnage. And I'm just like, I have a thesis, right? So you look at AI and you say, okay, billions of dollars into the platforms, they want to win the browser. And that's great. So, but the entire internet is built off of an ad network. That's how Google makes all of its money. And the thing that doesn't care about ads is AI and agents. You ask a query and you get a result. So the business model around AI is going to have to change. You're going to have to start charging for it. But more importantly, query-based engines, companies that are using AI that don't have stickiness are going to die. So one of the things that we look at is how sticky you are in the offering that you create. If you have a solution that says, ask a question around healthcare and get an answer about, what, illness you have, like WebMD, but powered on AI, you can swap out, there's no workflow lock-in for the user. You could just swap out a better engine and the user hasn't changed any behavior. So we look at sort of 4 things that are going to create lock-in for an AI company, because you have to have AI. It's very fast development cycles, as he says, but the lock-in is going to be workflow. Are you inside the workflow of a enterprise or a business, or are you in the workflow of a consumer so that it becomes hard to replace? Do you have access to proprietary data that nobody else is going to get access to? Do you have a systems level thinking? And this is really important, right? I don't care if they have expertise in AI stack 1, 2, or 3. Does the engineering team, can they quickly pull in, OpenAI versus Anthropic versus Mistral versus Liquid versus some other Gemini model, because that's the better model right now, and then swap it out for a different one later, right? So that's systems, and you might use 4 different models in your architecture because they're appropriate for, sort of generative imaging, or they're better for XYZ. So that level of thinking creates resiliency in a company. And the last piece is that you have to do this in a way where you allow the end user or the consumer or the business to make you smarter. Minute by minute, like produce the output, let them tune it, and now you get smarter and smarter and smarter. And that's where you create that edge. Because if you don't have lock-in, somebody's going to create a product in 2 weeks that's going to do exactly what you do. So you have to have lock-in.
So you've this is a great transition to my next question, and Roger, you've already partly answered it, but I'm going to sharpen it up a bit. So we're in a situation where the development cycle is so fast. The cost of building these companies is coming down, 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 down. You can spin out a new company, in a few weeks, with not a whole lot of money. The product is becoming commoditized to some extent, and things develop so quickly that what was a hot thing today is obsolete tomorrow. So how do you, as investors, evaluate the opportunities in front of you, and how have those factors changed the way that you think about how you make your investments, how you look at companies, how what is it? How has your thinking changed in a way, and in a way that people can action that, I guess? Okay.
Sure. So I think my perspective is a touch biased and maybe not quite as relevant compared to a generalist, in that all of the solutions that we are looking at, whether they are AI or otherwise, are selling to highly regulated institutions as their customer base. For the most, I would say 95% of the instances. So the sensitivities around regulatory compliance, the challenges of embedding yourself within that type of organization obviate a lot of the, shiny object syndrome that generalists, I think, generally have to contend with, because you have to be vetted to such a degree, because you have to go through really rigorous and onerous vendor assessment testing to be embedded in a lot of the architectures of the underlying customer bases. That's a double-edged sword. One, it takes a long time. So you have to contend with a longer sales cycle and a more challenging go-to-market. But on the flip side of that, once you're in, you're generally in, and the value of those contracts is typically quite high. That's allowed us to, I think about the world through probably a slightly longer lens than maybe some of my peers. With that being said, we're not immune to it. I invest quite heavily in blockchain infrastructure. That's gone through what feels like 10 cycles in the last 4 years. Right now, there's euphoria. There is a large IPO today, which renewed interest in the space. There's been tremendous volatility on the regulatory and legislative side there. So we have to be aware of the wins and the macro changes in that area. But what I would say to all of this is the defensibility of any company today has to be in question, with the exception of obviously mega organizations. But any sort of startup or even slightly established middle market player is at risk for disintermediation very, very quickly. And I think that has to weigh on the minds of the founders. I think there needs to be a lot more M&A in the next 2 to 4 years so that industry winners can, I think, start to coalesce and build moats around their businesses. Because the longer that time goes by, I think a lot of businesses are holding on to melting ice cubes without even realizing it.
Yeah. So, years ago, lines of code was a competitive advantage, and that's gone. And that's the problem, right? So I talk about lock-in all the time. Where is your workflow lock-in? There are companies getting funded all over the place. And I'm not trying to disparage my peers, but people just aren't conscious. They don't remember the past. And I remember the past because I'm an old guy, and I lived it. I saw the .com burst and, pets.com and you name it was out there. And so, people are getting funded. The question is, are we going to have exits here? And so software is no longer a competitive advantage or a sustainable advantage. You have to have, so I'll give you an example, like ChatGPT 3, when it first came out, cost $100 million to train and took 1.5 years. Now It costs about $450,000 to train and can be trained in like a month. And in a year and a half, it's going to be $45 to train, and it will be a minute to execute that. And so think about the attrition of value. Toast. We lost so much money pouring. Everybody is trying to leapfrog one another in this war, and there's no sustainable value that's being created in any of that. And so when he says, I see 10 companies and they catch up very quickly, you know, I think some of them are going to get funded and a lot of them are going to go to zero, but maybe down the road, I think the key here is you got to have lock-in. You got to have something that, so I'll give you an example of lock-in, right? So I've got a company called Open Envoy, and they're in the accounts payable space. So they basically work with manufacturing companies, and you got 1,000 parts vendors, and you got 1,000 contracts, you get 1,000 invoices every month. And they basically ingest the contracts and ingest the invoices, which are incredibly cryptic. They're like little codes everywhere. And they look at it and say, let's say you have a net 30 payable. This company will say, okay, this invoice is correct. We'll wait till day 29, hour 23, minute 59. We'll pay the bill. You get all that float. If it's incorrect, they'll basically wait the same amount of time and send an email back to the vendor and say, we're supposed to get a 7% discount. You only give us a 6% discount. We exceeded the volume thresholds. They get another invoice back, and they basically wait the same amount of time and they pay it. And everybody gets float. The lock-in here is ingesting all of the contracts from all the different vendors and the invoices to the point where they no longer need to train a new vendor, because 90% of the vendors are already on their platform and they understand it. So and the lock-in is, if you have a better Open Envoy that comes out the door, like same product, you are not going to do anything incrementally. If it's 2% better, you're not going to pull this thing out, because you put effort kind of integrating all your ERP systems in with this tool. So, and the customers are training it, saying, no, this was a little bit off, and they've gotten very smart. I've got another one that's focused. This one's kind of like crazy. I think investment bankers are going to be in trouble, but it's a company called Farsight, which I just invested in. And what it effectively does is, when you want to sell your company, you create a SIM. It's called a confidential information memorandum. So let's say a banker wins the deal. The head banker says, hey, there's these 5 companies that could buy your, maybe it's Amazon and Google and Microsoft and, whatever. And they take a data room and they ingest that data room, and they basically have analysts go back and forth all night long. My son's in the crowd. His girlfriend works at Evercore. So he knows she's up all night, doing all of this work. And so a month and a half later, you have a SIM. It's perfect. It's 60 pages. This product, you basically take your PowerPoint template, 60 slides, you give connectivity to the data room. 5 minutes later, you have a confidential information memorandum. And it says, here are the 6 buyers. The managing partner only found 4, but there's 2 customers that, they've basically said in their annual reports that they are interested in this space. And oh, by the way, these are the 4 ways. This is what this company is focused on in terms of the key stats. They don't care about EBITDA. They care about growth rate. And this is how they bought. This is the proclivities of that individual team, the M&A team. It's all right there in front of you in 5 minutes. But the lock-in there is that once you throw that PowerPoint in there and you tune it, it becomes much, much heavier and centric to your firm, so that it has learned exactly what the managing partner wants to present. And so the second time around, third time around, fourth time around, it's perfected the SIM. And 85% goes to 97%. That's lock-in.
All right. So in light of that, what are the traits of founders? What are you looking for in the founding team to convince you that a company has what it takes to win this fight?
I think there's just so much variability is unfortunately the answer there. And it's highly dependent on the stage at which we're investing. I think the characteristics of a pre-revenue seed stage team is just fundamentally different than a team that's raising a 25 or 30 or 40 million dollar Series A or Series B. But the generic attributes, obviously quick on their feet, acknowledge when they don't know something. I mean, I think that's one of the underappreciated elements of diligence. You have to ask a wide array of questions, some of which you should expect them not to know because they might be random or they might be partially relevant. And there needs to be an element of humility, and there needs to be an honest and authentic, transparent line of communication. Because if you are a meaningful stakeholder in these businesses, eventually you will get to a point with that founder where you need to have an authentic conversation. Even my best companies, I've had some very, very challenging conversations with because, look, they're growing really quickly and they're not addressing some structural needs internally. It's a very different challenge than companies that aren't growing and need to address product market fit. But if you can't look down the road and anticipate a clean and open dialogue with those individuals because of some of these other communicative factors, I think that's an immediate red flag. Obviously, look, technical prowess, experience in the field in which they're trying to penetrate, all those things that I could say, but everyone probably already knows. Those elements are pretty straightforward.
Yeah, I agree with everything you said. I'll add a few things. Humility and coachability are awesome. Like, that's really, really important. And, my background's wonky. I did 5 years at Bell Labs, then I ran international for AT&T and Lucent for a bunch of years, and then I did 3 startups. So I come from experience, right? Like, and if I tell an entrepreneur something, it's because I've seen it before, like really seen it before, either with myself or, 20 portfolio companies, whatever. And so that coachability aspect is important. But the other aspects I look for is I'd love founders that have the repeat founders that, because they've learned something along that first journey. I love people who have some domain knowledge. I like complete teams. You have the business and the technical. And the tricky one now, I'm really looking for people that are systems thinkers. Because if you are great at Python, and, code everything in Python, whatever, or you're great with, ChatGPT or, Claude or, Anthropic's engine, you need to be it's almost like you need a roboticist. They need to understand mechanical engineering, electrical engineering, vision systems, AI, software, and they kind of figure out where to apply what where. And that's the kind of thinking that's going to win in this war, right? So those are the companies that are going to sit there and say they're not married to a particular, code base. You could swap it out, replace it with something else, or put in a different AI framework for one piece of the workflow and a different AI framework for the second piece of the workflow. So that systems level thinking is really, that's when we get deep in with the companies, is to find out how they've established their architecture. But I think the domain knowledge is becoming more and more important because code is so easy to create. And so if you can fine tune the code and get ahead of the curve by understanding where the opportunities lie and where the frictions lies and where you need a human in the loop, that's really, really important right now.
Well, the one thing I'd add to that is, businesses aren't built by building a product. They're built by selling a product. And those are two very different things. So, if you don't have domain expertise and you don't know who you're selling to and why you're selling it to them and why they need it and all of those other attributes, you can build the best product in the world, but it'll stagnate. And I've seen that a number of times. So that domain expertise it's absolutely essential.
All right. I've had such a good conversation. I haven't done any Q&A, but we can take, we have more to talk about, but if there are questions, we can take them. But you'll have to raise your hand so we can give you a mic.
Hi, Matt Kaplowitz from Infinite Access. We've built a hyper-personalized utility engine for emergency communications. My question is about patents. How far can, in the early development process, how far can patents really protect, and how much is that just wishful thinking. And thank you for your presentation.
Yeah, I think the answer is it depends, right? Your first claim is super. If it's broad, it's good. I think in certain markets, it is valuable. The thing you have to ask yourself is, if a larger company violates your patent, do you have the ability to fight it? And if you really don't, then it's not going to be that valuable. The reality is they'll skim around the edges. You get some compensation. So I don't really pay attention to patents when I write checks. I look at, the systems level thinking, what's the value proposition, right? I failed to mention one thing. I love companies that have a fast time to value. So you install the thing and it gives you an ROI immediately. That's awesome. If it takes 6 months to train the damn thing, nobody's going to deploy it. And so, fast moving, fast ROI is better. I think patents are valuable in especially if it's a broad patent that covers a lot. But narrow patents with, limited claims, I don't think are useful. People work around them, and you usually don't have enough money to fight if it's a big company that violates.
Yeah, I don't have anything else to add. I agree wholeheartedly.
I'm going to add something to this anecdotally. In my firm, we've been going about a dozen years now, was a time when patents were pretty important to our clients. And I'd say 50 to 75% of our startup clients, they were applying for patents. In the last 2 or 3 years, much less. So I mean, it's clearly that has changed. The market's changed. The investment landscape has changed, and they don't have the same value. They're not as necessary, for investment rounds, I would say, or for growing companies. We can take another question.
We've seen Trump fire Shira Perlmutter for suggesting at the Librarian of Congress that AI companies should pay for their material, and we've seen Marjorie Taylor Greene oppose the state regulation of AI. How much does policy affect your thinking?
That's a loaded question, obviously. I think...
Well, turn off the recording now.
No, look, I mean, at the end of the day, I think there can be a policy goal in mind, but I think a policy execution here is extraordinarily difficult. I mean, you just think about what needs to occur for there to be an effective execution of what's been contemplated. And I just don't think that the way this technology has developed has really laid the foundation for that to even be viable. So I think it's a whole lot of optics and probably a lot less substance. Now, with that being said, regulations and legislations can be hugely punitive. And I think what it can do is really delay the time to market, the speed at which we innovate, and our competitiveness on a global field. That's a different issue than do we try to tax them or make them pay some sort of penalty or whatever, which I don't think they're going to be able to assess efficaciously. I think we should be far more concerned about the optics and the structural challenges with respect to our global competitiveness. I know that's probably a non-answer to the question, but...
Yeah, I don't pay a lot of attention to the regulations because... unless it's like blatant, like HIPAA laws, they've been around for a long time, things like that. The reality is, if it's an administrative change, I'm investing in a startup, it's probably going to be 7 to 10 years before we get out. You're going to have 2 new administrations in that time. And so policies are going to change. And so you can't really think about, sort of like, oh, there's an opportunity because this administration has created a certain policy, because there'll be a different one and the policy could change. So I think the horizon matters. Like if I was a late growth investor, policy would matter to me a lot because I'm trying to exit this company, and the reality is industries need to reinvent themselves. Music is a great example. I mentioned those 4 inflection points. Like there's a mini one called cloud, which is the 5th. So music first came out, like when the PC first came out, music had to get digital rights management because otherwise there would be no more money in music. Like everybody would steal everything. And, with Napster and all that kind of stuff. And then when internet came out, discovery of music went from websites and Billboard magazine to MySpace and YouTube. And then you had mobile, and distribution of music went through the mobile phone. Everything changed. Like nobody went to record stores or anything. It was all through the phone. And then we had cloud. You stopped buying music and you started streaming it. And now we have AI, and synthetic music is coming. And there are some regulations, right? You cannot copy somebody's voice or whatever, but the industry is going to have to evolve. And I just invested in a company called A Vinyl Shop in Shibuya. It was a chief product officer of Spotify. It's a good friend of mine. And he's working in the space of like redefining how to do sort of music in the AI era. But there are certain regulations like that you will not, like you cannot create a duplicate of Kanye or Drake's voice, but there's other things that were allowed, like in the DJ space, you could do sampling, it was like a small number of bars, and that was allowed. And you're going to see some real powerful innovation. But in the regulation, it sort of creates a guidepost, but it shouldn't just sort of prevent you from doing X, Y, or Z because it may change.
All right. So,
I guess I am either surprised or shocked that I thought 2/3 of this panel would be about AI. So that's probably a good thing, because we are in commerce, and to the point about being counter-cyclical, we think there's a lot of waste in the buy now, cry later category, as Barron's called it, and we're building the opposite: save away now to smile soon. So eliminating, credit, debt, regret, that entire cycle in commerce. To the point around, there are a lot of other categories that are not at the same level of shininess. And how are you detecting those signals, and how do you advise founders of other spaces that could be category making, create signals in this environment?
Yeah, and as we touched on earlier in the panel, there's tremendous opportunity in a lot of those areas, because I think they are not getting some of the attention that they might deserve or they might otherwise get in different types of market conditions. But it goes back to all the same characteristics that we talked about. It's, what pain point are you solving? Who's the buyer of your product? Do you have defensible business, a defensible business that can charge enough for that solution where your unit economics are attractive for my incremental capital? Do you have regulatory challenges that make going to market particularly difficult? If you can answer those questions eloquently, we absolutely have a pot of capital available to invest in those businesses. So I don't think there's like a void out there per se. I think there might be a void in the messaging. I mean, you're not seeing the headlines around it, and you're not seeing the euphoria that you are in some of these other areas, but that space is not dead. And I think there's been a lot of structurally questionable decisions in financial services over the last 5-ish years, particularly on the consumer side. And I think there's a lot of compelling investments in the personal financial management arena. And especially when you layer in and not to go back to AI, but if you think about what AI can do at the confluence of digitized money, personal financial management, and credit worthiness, and all those other things, you can contemplate some really interesting opportunities. And I think it's all about the story. But I wouldn't shy away from pursuing capital in this environment.
Yeah. No, I love boring industries. Like, that's fantastic, right? Like, so, you don't have much competition sometimes or whatever, but the reality is, you've got to understand, is it a tectonic shift that you're making in this space, or is it incrementally better? So I think AI is an enabler, right? I don't sit there and invest in an AI platform company. We didn't put any money in OpenAI, Anthropic, because I think they're all going to go to badly, frankly. But I love vertical industry focused things. We do ask the question every time, like, how do you leverage AI in this solution? And if you say, like, there's no place to apply it. Then maybe there's a place to apply it to write code a little faster for yourself, right? Or, figure out buying signals and signal strengths through AI. I think because it is going to have an impact that's going to be incredible. We got to figure out how people are going to pay for it, right? The internet was free, as I said, and AI, the agents don't care about ads. So what winds up happening is I think consumers are going to have to go like the Netflix route. There's enough content there, I'll willing to pay for it instead of watching TV for free and movies for free. I think something's going to have to, anybody who cracks the code on how money can be made in agentic models and, through a browser interface, come talk to me. Like, if you figure that out, I think blockchain is actually going to be a play here. Huge play, right? We have a ton of blockchain companies and crypto companies that we're invested in. And I think, stablecoin is the first area where I think makes sense, right? It's an obvious use case. You got to get rid of some gas fees and make it faster. But once you do that, fantastic. And I think another area is, how do you create a monetization model? Because each search doesn't cost the same amount in terms of CPU usage, right? And so tokenization models are happening. SaaS is going to die, like legit, right? I mean, everybody's got a SaaS company sit there and say, okay, I'm going to do this model where, pay annual subscription. If you include AI in your product, now you have to move to this model of like, am I going to get my gross margins, right? Because now, like, if I charge somebody $10,000 and I'm burning $50,000 to create video, unlimited, you're out of business. So you got to move to a tokenization model. So I think business models are going to change dramatically. It's quite interesting. I love this job. I mean, it's such a wonderful time to do this. Anyway. Sorry.
All right. So we're going to move towards wrapping things up here. A couple more questions. You guys have addressed this a little bit, but I'll do it a little more pointedly. What areas are you especially interested in over the next year or two? Where do you think are the breakout opportunities that, since whatever people are working on now may be obsolete tomorrow, what should they be thinking of? What's going to be hot in 6 months or a year from now?
I mean, I can only speak to what my underlying ecosystem partners are really looking for, because that's informing whether I find something interesting or not. And because we have a relatively narrow focus within our fund's mandate, you can take this for whatever value you get out of it. But to Raju's point, stablecoins and broader blockchain infrastructure, massively compelling. The future of finance is absolutely going to be underpinned by that technology, tokenization, digitized money, enablement infrastructure. So there's a lot that needs to be built to allow what I would call the real economy. I think HSBC and Blackstone and Lloyd's of London and Glencore, they're all going to be interacting with digitized forms of money. And all we've had for the last 15 to 20 years is digital representations of fiat. And the difference between digitized money and digital money is profound if you understand some of the nuance. Think decimals that go out infinitely, 24/7, 365 uptime, no latency, counterparty risk challenges, enterprise risk management challenges. There's hundreds of billions of dollars of market value that will be created building the infrastructure to power what I, again, call the real economy, to allow them to adopt these solutions. That's getting some airtime. I think there's been a tremendous resurgence in interest around stablecoins over the last 6 to 8 weeks, particularly around some of the legislative and regulatory events of that period. But we are in maybe the second inning here. So that's an area that I'm spending a lot of time. And then, to beat the horse that's quite dead, obviously, businesses that are leveraging AI, not AI businesses, but businesses that are leveraging AI. We have a number of solutions within our portfolio in the fraud, compliance, risk management, some of these back office areas, which are very human intensive, very data driven, very monotonous in their work streams, that are getting revolutionized in real time. And to Raju's point, huge stickiness in those products. Once they're embedded, they're in. So those are probably the two biggest areas for me.
For me, I think there's two. One is in the area of healthcare. Healthcare is like a sector that like is in the dark ages, right? Because it's highly regulated and highly fragmented. And so like 10 years ago, I said like, well, how come we don't have PC apps and, you know, internet stuff and mobile? Why hasn't AI, I mean, any of these inflection points been sort of realized in the healthcare space? And it's because it's highly regulated, highly fragmented, and there's no interest in sharing data. Well, the CMS just came out with a ruling that said you have to share your data now. And you know, back 8 years ago, I invested in a API company that was just doing interoperability for healthcare, and it is hitting an inflection point right now. Because if you want to do anything interesting in healthcare, you need to get data from different sources, and you need to be able to read, write. And so interoperability is going to enable a lot of interesting AI applications. But I think the areas I'm most interested in is how, now that interoperability is going to be mandated, what can you do with it? Like better clinical trials can be done because you can target people that maybe have the illness as opposed to having volunteers come out. You're going to see a lot of personalized health applications, which I love. So that's one sector. And then verticalized AI. So areas that, you know, basically just businesses that have found a hole, and they found a hole, they filled it, it has stickiness, they have access to proprietary data, they're getting smarter because the end users are training them, or a human in the loop is training them. And, you know, they're basically impossible to displace after they've gotten a certain amount of, you know, effort done. The bigger spaces, like everybody says, I want to look for that $1 trillion market or that $100 billion market. The problem with that, honestly, is that you had, as I said, $287 billion go into all of this platform companies, and the grand total of $12 billion in revenue from those platform companies. They're hurting. They have 5% return, like in terms of the dollars. And so they're going to go after the big fish. Johnny Ive's company was bought by OpenAI. I don't know why, but I have a big speculation. It's because they want to sit in everybody's home. Alexa's going to be dead. OpenAI is going to build this product that can just do, because they need access to everyone. They're going to go after big problems. That's why they want to win search and, you know, conquer Google or whatever. They're not going to go after Farsight, which is making a sim better, because maybe that's a $5 billion market. $5 billion market doesn't do anything for OpenAI and Anthropic. So, because you do worry that these behemoths are going to be going after something, but they're going to have to take down big chunks. So I like little chunks. I think I can make a lot of money in little chunks.
All right. Last licks. When you each take a minute or so and final advice to people who are out there. A lot of these folks are early stage founders trying to raise a first round. What last advice for them?
Like I wish I had, more pearls of wisdom. I feel like we've shared a lot on this panel, but I would stress the fact that, there is a lot of money out there, and we're all looking for compelling opportunities to deploy capital. So, going out with a confident story, being prepared to hear no a lot more times than you're going to hear yes. You just have to condition yourself. It's not personal. Being diligent on follow-up. I really try to follow up with every company that we meet with, but I can't say I've got 100% hit rate there. And that's nothing personal. It's just a function of how busy we are. Be persistent. And then really have polished answers on your unit economics, your capital ask and why and how it's going to be spent, what problem you're solving, and when you can solve it. Not we want to build something for some abstract date in the future to solve some problem that we think exists, but hey, we have built or we are actively building a solution that solves this problem, and we can be live at this date, and here are the customers that it makes sense to go after, and here are the ones that have expressed interest in the product. This can be a pre-revenue company, and you can have those pieces of information, that gives me a tremendous amount of confidence that my capital will be spent effectively in a time horizon that makes sense, solving a problem that I understand, and that can be validated through channel checks. That's the pitch 101. It doesn't really get that much more complicated.
I always tell entrepreneurs two things every time. If you've pitched me, you've heard this. Like, more startups will die from indigestion than starvation. So if you try to bite off too many things,
Yes.
you will die. And the second is the greatest companies are created with great sequencing. So even though you're going to start at this, tip of the spear, I love whiteboard sessions with my founders, right? I just go in there and like, okay, pitch me, but don't show me like, what's your roadmap? What is you start with this, and then, think about it when you're doing moguls, you have to kind of see your line. Otherwise you're going to blow up, or you're trying to cross a river on stones, right? You got to see which stones to jump on, because if you go to the wrong stone, that's no jumping point from there. You go backwards, right? So knowing the sequence, like I can get this customer and then it unlocks this, or I get this product and it gives me the right, and once it's dispersed in the company, I have the right to tack on this and this and this. So that is really important, right, to me. Indigestion and the sequencing piece. And the second is, I think the founders that raise money are great storytellers. And that is the honest God truth. Practice your storytelling, because, listen, we get 2,000 pitches a year. I mean, it's ridiculous, right? You can't even possibly. I invest in 3 companies, right? And so when somebody tells me a story, it basically boils down, sort of the company's sort of chronology or some sort of evolution, and it becomes engaging. And the reason I love it so much is not because, hey, this company has a better technology, but they told a bad story. You're going to have to fundraise again. Yeah. And people love great stories. So if I think you're telling a great story, and it's the salesmanship piece that he talked about. You have to be able to sell your product. You also have to be able to sell your company. And so that salesmanship through storytelling is a gift, but it's a practice gift. So you guys should practice it.
All right. I think that we're going to wrap on that. Let's have a big round of applause for our panel. Thank you to Raju. Thank you to John. We are going to be around here for a while. We all love talking to founders who are doing cool stuff. So seek us out, especially here, or reach out to us. The contact information is on these nice acrylic stands, or the QR code. If you go to that QR code, you can leave your contact information so we can follow up if you'd like the video, if you'd like to be on our mailing list for other events like these. We do, or I should say I do, a series on various issues for startup companies, like financing, M&A, learning how to do an investor pitch, a variety of topics that are of use to companies that are just getting started. So if you get on our mailing list, you'll see the other events we have. The bar is still open. I don't know if there's still food. So hang around, enjoy. Thanks very much.